All right, I'm Michael Hartzman. Today is Tuesday, November 18th, and I'm on this evening with Tracy Byrnes, subbing for Dominic tonight. And Tracy is one of Lebenthal's own and Vice President of Women in Investing. How are you, Tracy?
I am good, considering all that's going on.
There's a lot going on. Dom and I did a show last week, just the two of us, and the time flew. We had so many topics to go over. Um, and look, I guess the only thing that's changed materially from last week to this week is the shutdown's over. Thank goodness for all the people who were affected by it. The market's still on some shaky ground. Last week, just to go over the numbers like we typically do, the S&P was kind of flat. The Dow was kind of flat. They were both up. Well, the S&P was up 12 basis points, and the Dow was up 41 basis points, and the Nasdaq was down 43 basis points. And for the quarter, which we're about halfway through, there's really not much going on there, Tracy. The quarter, the S&P is up less than one. The Dow is up a little less than two, 1.77, and the Nasdaq is up 1.11. But year to date, we still have some really healthy returns. So it seems to be we're kind of in this fall doldrums, and at the moment, driven by some fear of the market's run up as related to AI and technology. But it just seems right now there's a lot of uncertainty, and all the large investors just are taking. My impression is they're taking a little bit of a wait and see attitude right now.
Yeah, I think we've all been waiting for the shoe to drop, right? On when everyone was going to turn around and say, "Okay, you're investing all this money. When do we get to see our side, right? When do we get show me the money kind of thing?" And we knew it was coming, and it just, I guess maybe the shutdown was over. Michael, we went from talking every day about healthcare to not hearing a word about it since the shutdown ended, right? I find that very fascinating. Now all we're talking about are the Epstein files. But maybe it's the next thing that we need to be focused on. I don't know, because the timing seems semi coincidental to me. But we knew it was coming, in that someone somewhere was going to start to question, okay, it's $1 trillion. When do we get to see the return on this?
I completely agree, and we've covered that ground, and we've gone to meetings with some very large financial institutions and talking about it. And the one thing which is entirely anecdotal, but maybe not, is, and again, I mentioned this last week to Dom. If I would have told you in the beginning of the year that after technology and communication services, the third best sector in 2025 would be utilities. Would you have made that bet?
No, never in 1 million years, right? But
Right,
I think
never.
that's a story we're not talking about.
Right. So to me, people are talking about the Mag Seven and these AI giants, all spending money on each other, and there's circling money running around. But my argument, Tracy, is the money's going somewhere. Whether it's
Yeah.
going to build the infrastructure, it's going to build data centers. They're not just spending it on each other, they're also spending it on this huge, massive build out. I think unlike anything we've ever seen. I have no idea what it cost 25 years ago to lay fiber cable underneath the Atlantic and Pacific Oceans, but I would venture to guess we're spending more now on this AI build out than we spent then.
Right, 100%. And I think, but again, I also think that's the part of the story that's not being talked about enough. All we talk about are these Mag 7 and what they're doing, and their earnings, and Nvidia, of course, tonight to end the party. I think at the end of the day, this brings us all back to the need for diversification. Energy too has been, such a hot sector that, again, people are a little bit nervous about. But there's a dichotomy in the market, and we talk about this too, right? On one hand, we have all this nervousness. On the other hand, you have a consumer that could not be more robust, that can't wait to get out there to spend because their investment accounts are up. They're expecting a pretty decent holiday season. National Retail Federation says they're going to spend $1 trillion, whoever they are. I don't know if they're buying Mercedes as opposed to Tickle Me Elmo when my kids were little, but there's an anticipation that people are going to get out there and spend regardless of all of this.
Tickle me Elmo, you're definitely showing your age there.
I swear I almost had to take people out back to get one, by the way. It was so hard to find.
We were a Teddy Ruxpin family, I'll just have you know.
Okay.
Which has given birth to the iconic movie Ted, which is also that's a topic for another night. But you know, yes, we're having this build out, and we talk about the consumer. But when you talk about the consumer, and this is one of Dominic's favorite subjects, so there's also this bifurcation where you're right. There are many, many, many 401k millionaires and multimillionaires who could never have imagined that in their wildest dreams. And they do feel good about their balances and their net worth, and they should. And thank God they're spending money. But there's also a lower quarter or a third of the population who still are really hit hard by higher prices. And it is a little bit of deja vu all over again, where, you know, Trump is saying there's nothing to see here. I generally believe that cost the Democrats the election last year, and we're not bumping against an election this time. But I don't see the value of whoever is in office trying to convince people they're not feeling what they're feeling with their own wallets.
1,000%. I think the word is like affordability. Trump used it to get in. He said he was going to make things more affordable. And this most recent election, they all won on that same stance. We need New Jersey needs affordable energy. Like the word came up time and time again, because you are right. The total bifurcation in the consumer, even. I mean, the rich are going to spend, and they're probably going to be the 1% is going to probably carry that $1 trillion that the National Retail Federation is expecting. But if you're a W-2 employee, if you are on a fixed income and you have a bunch of kids and you're trying to pay for college and healthcare and all the things, you are struggling for sure.
Yeah.
And I don't think it's going to get any easier anytime soon. So any politician that gets up and says, I can make your life better and more affordable, they're going to probably get your vote.
Well, that's exactly what happened. I remember last year, running up to the presidential election, you know, the Republican talking heads were talking about how terrible the economy is. And the Democrats never ever talked about how great the stock market was. And it's the same thing this year. I was watching, you know, Dom's on the show, so I could say it. I was watching CNN, and you know, there was a Democratic strategist talking about how the economy is a dumpster fire. That was her phraseology. I'm sitting there going, the economy's not a dumpster fire. But for, as I said, the people on the lower end of the stratosphere, the message always works because it always seems to be true. The only time I think the lower end of the working class population feels good is when they're getting some type of bonus check from either the government or their employers, I mean.
Right. And if they get one next year, the $2,000 from the tariffs, then maybe that solidifies another vote. I don't know. I don't know what it does. I also think, though, that, you know, lower middle class is worried about their jobs, in that there is a displacement out there, right? With AI, we don't know what it's going to look like. There's actually a huge bifurcation in the job market. Healthcare is on fire. Everything else feels like it's getting displaced on some level. We don't know what it's going to look like. I say all the time, I'm thrilled that my last is getting out of college this year, because I don't know what it's going to look like in 10 years. It's going to be very, very different. And so I think that there's an uncertainty there, and nobody likes that.
You know, and the other thing is, you talk about healthcare, and the whole theme of the shutdown, you're right, was how hospitals are going to be closing and how people are not going to be able to afford healthcare. And again, I don't know. I'm not a political strategist. I don't watch it that closely. But if that is true, if people are going to be dependent on social networks and local hospitals are going to be closing, that has to create a drag on the economy, if that's not, you know, again, Democratic hyperbole and talking points.
Right. And again, I come back to the media probably because of my background. It's hard to figure out who to trust. and what to believe, because headlines sell, and people like big loud headlines, and they like to take stances on them, and the world is so polarized these days that they take a headline and they run with it without any kind of research or background. And so I think it just makes things even more complicated for the people that just don't know what's going on.
You know, there's your media chops, because we now created enough fodder for our guests this evening to really put them on the spot, whether it's AI or healthcare or inflation or interest rates. We have a lot to cover, and we're bringing back an old friend of both of ours, John Eade, who's the president of August Research and chair of their investment policy committee, has been gracious to be on our show numerous times. He's probably on at least twice a year. And when you found out you were subbing for Dom tonight, and John was our guest, he's an old friend of yours from your days being
Yes.
An anchor on a network.
Yeah, super excited. He's like, between John and his firm, they're some of the smartest people on the street. So it's a treat to have him here.
Well, we hope there's some of the smartest people on the street, because they manage a lot of money for us. So on that note, we'll take a quick break, and we will be right back with John Eade, president of August Research. All right, I'm Michael Hartzman, back with my co-host this evening, Tracy Byrnes, sitting in for Dominic Tavella, and our guest, John Eade, returning guest, returning friend, president of August Research and chair of their investment policy committee. How are you, John?
Michael, I'm terrific. Thank you. Thank you for having me on tonight.
We always appreciate the time. So, John, let me just start with paraphrasing Arnold Schwarzenegger from Kindergarten Cop. In my opinion, it's not a bubble. So let's start there. Every day we're getting bombarded. It's an AI bubble. It's 1999. It's unsustainable. Data centers aren't real. These are going to be empty buildings. Could you help us and our audience kind of make sense of all that? Because again, I really do believe, all kidding aside, that it's not a bubble, that this is real. And if it's not real, we're not going to find out in 2 weeks. We're not going to find, it's going to take 2 or 3 years to find out.
Right. Okay. Yeah, sure. That's a very important topic here. And we could talk about it I think in the context of a couple different things. One is we're in a bull market, right? The S&P 500 is up 13% this year. You wouldn't know that, but that's a pretty good year, Michael.
Hmm.
To be honest, you talked about starting the year. Did you think that utilities would do so well? Well, we had a few forecasts at the beginning of the year. I think I shared them with you. We thought that the economy would avoid a recession and grow about 2%. We thought that the Fed would be cutting rates again. We thought that corporate earnings would be growing at a double-digit rate. And we thought that stocks would do a little bit better than the average of 10% a year. And here they are at 13%. So, right there, we're 4 for 4 on this. And you take this year and you put it in the context of a bull market that started in October 22. So the average bull market since World War II usually lasts 5 or 6 years. We're about 3 years in. Stocks usually rise 150, 160% in those bull markets. More later, we're up about 90% in this bull market. So we're not in the early innings. I wouldn't say that, but I think we're still probably in the middle earnings of a bull market. And there are going to be challenges that investors go through during a bull market. It could be, uncertainty around an election that we had last year. It could be geopolitical developments. We've had enough of those. It could be inflation. It could be the economy. There are always these issues. And the issue right now um, is this idea of an AI bubble. So I guess a couple things I'd like to say about AI valuations, because I'm with you. I'm not going to call it a bubble, because when you think of a bubble, you think of a bubble popping, and then there's nothing there. And that might have been true during the dot-com bubble when these companies were collecting eyeballs and hits on the website and not subscription revenue or let alone profits. Or, you think of a bubble like the subprime mortgage crisis where, the banks were creating new assets out of mortgage paper, splitting it into leveraging it. There really wasn't anything there. And so when the bubble popped, there was quite a bit of pain. Here we've got, like you talked about, trillions of dollars investment into data centers, into software development. And then there's further investment, acquiring the software and the hardware in order to install the AI in all different industries across the country, which is just starting right now. Healthcare, defense, industrial, consumer. That's going to be another wave of AI above and beyond the real focus lately that has been a lot of those Mag 7 stocks, the Nvidias, the Metas, and so forth. So we're coming through earnings season now, and we're having a great earnings season. Earnings are up like 17% year over year with 8% top line growth. And most of that is coming out of the technology sector, the semiconductor sector, which is the big driver of AI. These are real earnings, great growth, record levels. It's not nothing. There is something there. But what I want to say at the same time is, you look at a stock like Nvidia and they report earnings tomorrow, and Nvidia is now the largest stock in the S&P 500, which is an honor, but it's almost a curse too, because you can't get any bigger. Talk to GE about that. Talk to Cisco. Talk to ExxonMobil about that, right? At some time or another, all of those were the biggest stocks in the S&P 500. It's not that they're, bad companies or they still aren't important, but then they're not growing at that pace that they did when they claimed that very top spot. So it's probably reasonable to expect a slowdown in the acceleration of these leading Mag 7 companies that are driving the AI revolution. But I don't think you're going to see a pop because I think there's a lot of assets there. And the bubble that I would like to compare it to, Michael, is one that doesn't get talked about very much, but that is the benchmark 10-year Treasury bond yield. Do you remember what that was during the pandemic? It was 0.6%. That is nosebleed bubble levels. And you could say that it has popped, right? Because the yield is now around 4%. However, there's so much real assets to the 10-year Treasury bond, to the U.S. financial system, to the Treasury market. And during that popping of the bubble, we've now started a second bull market. So if you're invested in other parts of the economy, you can still do okay, even if this one highly priced part of the market doesn't do as well on a performance basis. So that's kind of how I think about these high prices of the Mag 7 here. There's a real base there, a real asset, but it's probably not a bad idea to start looking at other investment opportunities now.
Not to beat this AI horse to death, and I'm aging myself again by saying it's like putting an athlete on the cover of Sports Illustrated. It's the kiss of death. But do you worry that these big companies, because right now most of them are using cash basically to make these big investments. Do you worry that when they start turning to debt to build more data centers and to build out more projects like this, does that make you start to worry about this at all?
You'd have to look, I think, Tracy, at the cost of that debt and the return on the capital. And I do believe that that's what the market is looking at over time. Are the returns on capital higher than the cost of capital? And as long as they get that right, and my guess is the banks are going to be, offering pretty sweet debt deals to these big tech companies with what are their margins, like 60%, something like that.
Right.
They generate a lot of cash. It's something to keep an eye on for sure. And a lot of people will watch the spreads in the bond market, the spreads between the triple A's and the treasuries and the triple B's and the treasuries. And if you start to see those spreads really tick higher, spike higher, now you're going to worry that maybe these companies are over leveraged. But right now the spreads are historically low. I think we're in an okay spot here.
So, John, to that point, the other story that seems to bounce around cyberspace is what's the logic behind Amazon investing in Apple and Apple investing in Meta and Meta investing in Google? Like they're all like lending money to each other, doing this circular dance. What's the end game to that?
Probably too big to merge, right? I'm not sure that Justice Department would sign off. But obviously, Google has had a great relationship with Apple to have its search engine, pop right up when you turn on your iPhone. These are a lot of business partners and business deals. And you mentioned Apple. I think Apple, it's a Mag 7 stock, but the real Mag 7 superstars this year have been Nvidia and Microsoft and Meta. And maybe when that high tech investment and development of the software and semiconductors winds down, and the consumer starts to be more involved and benefiting from AI, there's going to be Apple right there with the fanciest gadgets and the best tools, and they're already talking with these companies about what they're doing.
That's where the word oligarchy comes in and things like that. And I think that's the part where the investor starts to get nervous, right? When the world is run by, it was run by the billionaires. Now it's just run by these 7 companies that are just investing in each other, to Michael's point. I think that creates nervousness among investors who aren't in those companies, right?
Right. Yes. They get dangerously big and controlling. And you know what? I think like our whole U.S. government is set up to try to have the checks and balances to make sure that control doesn't get concentrated, and we'll see if that comes through in the market too.
Yeah.
John, another expression that I think it's the one of the buzzwords of 2025 is data centers.
Mm-hmm.
What's a data center? What's a data center, John? Why is that important?
Well, so a data center is where the semiconductors are powering all of the AI calculations that then get shipped out to the different companies that are integrating the efficiencies from AI into their operations. And these semiconductors require a lot of space. They require a lot of water. They require a lot of energy. That's one of the reasons why the utilities are doing so well this year. The data centers don't tend to be, in Midtown Manhattan. That real estate is too expensive. They're generally like in the suburban or ex-urban rings, close enough to power the corporations closer to the city, but not completely visible like you'd walk by one when you get off your train at Grand Central every day.
So you had mentioned diversifying out of the Mag 7. Is this where you'd go then? These data centers, water, energy?
Well, yeah, I'd look at the places that are going to be the groups that are going to be benefiting from AI, that are constantly aggregating and analyzing data and pricing services based on trends that they see in the data. So, financial services is a spot where you've got in financial services, it's not just banks and insurance companies anymore. It's exchanges, it's credit card companies, it's data companies. I think those are good growth areas. For one, financial services. In industrials, right? A lot of the artificial intelligence is ultimately going to be involved in autonomous driving, and that's coming out of the auto sector. But there's all kinds of automotive suppliers and manufacturers in the industrial group that are that is initiative isn't completely off the ground yet, but in 5 to 10 years it will be, and that's where a lot of the work is going on.
John, switching gears, as I said earlier, there are a lot of 401k millionaires and multimillionaires, and they're the ones who are spending money. And then there's also people who always have a hard time making ends meet. And Trump has been criticized, and the Republicans have been criticized for kind of downplaying a tick up in inflation. And the buzzword out of Washington this week is affordability. So I'm not going to ask you about that, but I am going to ask you about the Fed and interest rates. So what's your crystal ball say for December? Does the Fed wait because we're getting this tick up in inflation, or does the Fed act and lower interest rates to make life easier for the consumer? Do they do nothing? Where do you guys in August see the Feds doing at their next meeting or two?
So, okay, that is a great question, and I could talk a while on that. So I'll start. we expect a cut in the federal funds rate in December. So 3 cuts this year, and then we expect one more cut in the first half of next year, and then Powell is gone. Okay. So, Powell over the summer indicated that he's now more concerned about unemployment and the consumer, to your point, than he is about inflation. I think they were worried about inflation at the first half of the year because they thought tariffs might shoot inflation a lot higher. It pushed a little bit higher, but I think that stopped rising and that's stable. I think the Fed sees that and now is focused on the second part of its mandate to try to achieve full employment. I think it's going to be interesting when Trump's next Federal Reserve chairman starts in May, because that's going to be somebody who's going to be under a lot of pressure to start lowering rates right away, which is what Trump wants. But I think what Powell is trying to do is get the Fed funds rate to a neutral rate before he retires in May. And the Fed's fund rate right now is like between 3.25% and 4%. And if he does 2 more cuts, that gets it to, 3.25% approximately. And inflation, I think, is going to be running around 2.3, 2.4 early next year. So you've got that 100 basis point neutral rate, and the next Fed chairman comes in, won't be under the gun to do anything radical right away. So that's what we see happening with the Federal Reserve. Another thing that the Fed has done, and it hasn't been such a big announcement, was that they've stopped their quantitative tightening program. Right, the QE came out. It helped during the Great Recession. It helped during the pandemic. The balance sheet became swollen. So the Fed has been taking bonds out of circulation, and when you reduce supply, that increases prices. So the Fed is done with that now. There's not going to be any kind of technical action. I think that can help keep interest rates low because they're not going to be reducing the supply. One other thing that they're going to do, Michael, and this is the last thing I'll say, is the stable coins are supposed to come out next year, and the stable coins are going to be backed by treasury bills. So the Fed is going to be focusing on issuing short-term securities, not so many 10 years and 30 years. And again, with less supply, I think the prices are going to go up and the interest rates are going to come down. And I think we're going to have a steep yield curve and continued lower rates into 2026.
So, Joe, you mentioned stable coins. You talking about cryptocurrency?
Yes.
Well, that is a fantastic place to take a break then. So let's take a break now. Give John a chance to catch his breath, and when we come back, we will talk about the economy. And then John just brought up cryptocurrency. That was not on the bingo card. So we'll be right back with John Eade, the president of Argus Research. All right, I'm Michael Hartzman, back with my co-host this evening, Tracy Byrnes, sitting in for Dominic, and our guest, John Eade, the president of August Research and chairman of the Investment Policy Committee. So, John, I don't make predictions like August does in the beginning of the year, but if data centers was the buzzword of 2025, I'm going to say right now that stablecoin will be the buzzword of 2026. Most people do not know even what cryptocurrency is or Bitcoin is. It's still a mystery to a lot of investors. Those who know stablecoin's important. So, you mentioned it. Obviously, you guys use it in some of your model portfolios. I mean, crypto. So, what is the relevance of stablecoin as it relates to either crypto generically or Bitcoin in particular?
So Michael, with I would say about crypto in general, right? It's been around what 10, 20 years now, and it was dangerous and murky and not transparent at all for probably 18 of those years. Not traded on any exchanges, kind of mined in back alleys and so forth. But then the SEC, but still growing as an asset. So cryptocurrency now is the total assets in cryptocurrency are $3 trillion, 4 trillion dollars, and that compares to a traditional portfolio alternative asset class of gold, which is about $12 trillion. So gold is much bigger than crypto, but crypto isn't small anymore, and it started to get on people's radars, particularly when you get the crazy moonshots in different years. But even more important than that, Michael, is crypto is being more and more regulated. So there's a lot more people looking at it, trying to make sure that it's safer, more transparent than it's been in the past. So one of the big steps forward a couple of years ago, the SEC approved ETFs based on Bitcoin and other cryptocurrencies. So now you could buy exposure into cryptocurrency, and you didn't have to try to find a dealer and buy a Bitcoin and get it stored somewhere. You could just go to any broker and buy an ETF and own exposure to cryptocurrency. So that was a one big step with the Bitcoin. Now the stable coin is building on that level of transparency. With the stable coin, it's designed to be right. When you go back to Bitcoin, it's supposed to be a currency, but nobody is going to pay Bitcoin for a ticket to a ball game or a hot dog or anything.
Right.
It's just not practical. But stablecoin is supposed to get closer to a crypto currency, and part of what makes it stable is it's going to be backed by investments in U.S. Treasuries. I don't know the ratio, but it reminds me of the old gold standard where um, the price of gold was based on the bars that they kept in Fort Knox, and there was always like a real asset behind the value of the gold in any sovereign bank vault. So there's more transparency coming for Bitcoin. It's probably going to be moving more in the mainstream. I still don't think you're going to use stable coins to buy a ticket to the Mets home opener, but I do think it. I'm not going to call it a freight train, but I do think it is a trend that is moving toward the mainstream, and it's not going to surpass gold as a $12 trillion asset class anytime soon. But we're seeing it more and more in different uh, portfolios among our clients and other people out there on the street. Small part, never more than 1 or 2%. But that's the role of alternatives in these diversified portfolios. They zig when the rest of the market zags, theoretically.
All right, so I would almost argue that the optional word of 2026 or words is private credit as well, for the same exact reason, right? We're throwing that around a lot lately too. But John, to your point, and Michael mentioned it, majority of the people that own some version of crypto do not know what the heck it is, but yet they're in it because of FOMO, right? The fear of missing out. I mean, I had the great pleasure of interviewing the Winklevoss twins. I don't think I
Oh,
said that right.
yeah.
1,000 years ago. So we have been talking about this forever, and yet it's still so esoteric. Do you worry that people are lobbing into this and jumping into this for the completely wrong reasons? Again, just to follow the herd.
It doesn't come close to being for everybody, Tracy, right?
Right.
You really have to know your client and their risk tolerance level and their time horizon. And you've got to protect them by having it as a small part of a portfolio. And if there's a pain threshold that you can't take anymore, set it and move on if that happens. However, 5 years ago, it was a $1 trillion asset class. Now it's a $3 trillion asset class. The president is behind it. The regulators are improving transparency. So there's some dots to connect there to think that it could continue to become not quite mainstream, but just bigger than it is right now.
And guys, I think the other phenomenal use case for stablecoin is, you're right, you're not going to buy tickets to the Mets home opener with it, but maybe now you could buy a car with it. And because stablecoin is just that, my understanding of it is kind of levels out the price. Because I think the argument always of Bitcoin is, whether you're the purchaser or the seller, how do you make a major purchase and use your Bitcoin if tomorrow the value of that could be down literally thousands of dollars, right? So I think that is what makes stablecoin more valuable, is that I think it levels out the playing field. And yes, you're not going to buy a hot dog with it, but maybe now you're more comfortable making a car purchase, or paying for an extension on your home with that money.
Yeah, it'll be new,
right? So I'm gonna pivot us a little bit. I always ask this question, John. What keeps you up at night these days?
Let's see. I think it would be. I don't like the pressure that the president has been putting on the Federal Reserve. I think that independence of the Fed and the integrity of the U.S. financial system is part of the backbone of our country's economy, which, I don't think it's any coincidence that it's the strongest, most diversified, and most robust economy in the world. It's the envy of the world, and that's why, the U.S. dollar is the currency of choice. And we as a nation benefit from that a lot. So you look for reasons of what's going to chip away at that credibility, and is it going to be that we have too much debt on our balance sheet? And I think right now our debt to GDP ratio is 120%, and 60 years ago it was 40%. Is 120% too high? Well, Switzerland has 30%, but Japan has 250%. So it kind of depends. It is too high if there's no confidence, though, in the independence of the people who are making the decisions about the financial plumbing and about the interest rates in our country. So one thing, Tracy, we've started to do this year in we have a blog that goes out every day. At least once a month, we take a look at what's going on with the U.S. dollar. It's down a little bit this year, and that's because of a lot of the trade and tariff, um, uh, what's happened with tariffs, and countries are pulling assets out of the U.S. because they're not doing as much business in the U.S. But it still is up since the pandemic. It's fallen only 5%, not like 20 or 30%. But that's something we weren't thinking about a couple of years ago. We weren't so worried about the dollar. We weren't so worried about the Federal Reserve's independence. And we talked about the transition of the new Fed chairman coming on next May. We'll be watching that very closely.
John, it's interesting that you say that, because we had you on in the summertime. I think it was the week after that Trump fired the messenger. I think it was the head of the chief of Bureau of Labor Statistics. And if you remember a couple of months ago, everyone was concerned that is that information going to be tainted? Is Trump going to try to put his finger on that scale? And I was a little nervous about that night. And you were extremely calm about that. You were very logical. You talked me down off the cliff a little bit that evening. So, what makes you feel that this time, if he hires one of the Kevins, Kevin Haster, and I forgot the other one, that they're his guys? Is that kind of the buzz on the street, or is it just kind of anecdotal internally? Because I feel the same way, right? I do feel that if we can put the finger on the scale, and the Fed's going to make decisions because they don't want to anger their boss, well, that does taint the integrity of our financial system.
Right. I am comforted by the fact that Trump did pick Powell, and Powell has been as independent as they come, and like I mentioned, he's trying to get that soft landing of interest rates to that neutral rate, before he gets pushed out. So, I think the candidates are pretty strong, Michael. But if you get a guy coming in May, and next December we're at well, he takes interest rates to zero, right? Like Bernanke did during the financial crisis, or Powell did during the pandemic. There's not that kind of crisis now, and we all know that Trump wants lower rates. I'm not saying that's going to happen, but that's obviously what you don't want to have happen, and you want to make sure that not just the institution is independent, but the appearance is of independence as well.
But we've talked about this, and I think that's where the struggle comes in, because I have no college funds left. I usually put my kids' college funds on the table when I'm betting. But if someone comes in May, they're probably going to lower rates. And the question will be, are they doing it because Trump wants them to do it, or are they doing it because the economy is asking for it? And I think, again, that causes uncertainty, and it kind of throws the markets in a little turmoil if indeed that happens.
Well, you know what, Tracy? We have looked at the dollar over the past month, and even with the government out, the dollar is up a little bit. So there still is some faith in the U.S. financial system, at least for now.
Yeah, and to your point, Tracy, that's going to be right before the midterm elections, and lowering rates to zero or close to zero makes them the exact opposite message that the administration wants about a healthy economy heading into the midterm elections.
Yeah, 100%.
So, John, again, switching gears with the last few minutes we have, and I know we have about 6 weeks to go left in this year. I heard what you said about the market and about earnings. Is it too early to ask you what August's themes are for 2026?
Well, a couple things on that, Michael. Certainly AI is going to be a theme, and we do a webinar every month for our clients. And the February webinar is going to be just like the foundation of AI, the software and the hardware. And then we're going to go sector by sector. We're going to have our healthcare analysts talking about AI in healthcare, our energy analysts, our utility analysts. We're going to go through all of the different sectors in the first half of the year, and look to see how AI is being deployed and what it's achieving. So it's like first derivative of AI. It's not getting it out there, it's getting it into operations. So that's going to be a theme. Two more quick themes, and these are pretty consistent themes for us, but there is a lot of uncertainty in the economy right now, on employment, on interest rates, on inflation. So companies do report, and that's something, right? They want to have companies report only twice a year. Right now, companies report 4 times a year. That gives you a lot of transparency into how businesses are doing. And companies are able to, I think, signal to investors that their businesses are going well. If they do things like, boost the dividend 8, 10%, that's a message to the street that things are looking good. Or, if they're raising their guidance, we're looking at this last quarter, we did better than expected. Things look good in the future. We're raising the guidance. So those kinds of signals from management, we think, can help our analysts, cut through uncertainty in certain areas of the economy and focus on businesses that are thriving amid the uncertainty.
Isn't it funny? I think we all thought we were going to fall off the cliff without the BLS reports, and that we weren't going to be able to function without this data. And meanwhile, I think everybody's doing just fine. Quite frankly, ADP has risen to the occasion. I think they're coming out weekly now until this is all figured out. Does the BLS, though, when it does finally come back, has it lost all validity? I mean, it doesn't, I'm not sure it means a whole heck of a lot anymore to people.
I think it does, Tracy. It's, going to have the most economists collecting, surveyors collecting the information. It's going to be the most comprehensive. It's the longest data set put there together. ADP's only been doing this for, I don't know, a couple decades. However long the BLS has been doing it is certainly longer. Plus, theoretically, it's going to have that stamp of the U.S. government, which should still be worth something. But yeah, you're right.
They gotta stop
ISM
the
has come out with
surveys.
numbers. There've been a lot of alternative sources.
Yeah.
Challenger, Gray, and Christmas.
Yep.
People find a way.
Yep.
John, I can't let you go without talking about international. We had an analyst on from JP Morgan 2 weeks ago. JP Morgan is very excited about the opportunity there. Where does August stand internationally going into 2026?
So Michael, I would say since the probably the Great Recession, right? Maybe the last time Europe did really well is when the euro was launched and there was all the excitement and optimism about all the efficiencies that were going to be achieved with these, fewer borders and bureaucratic snags. But then the global financial crisis hit, and there was no reason to own international stocks outside of US stocks. They all tanked. Everything tanked. But what came back over the next 15 years really was US stocks. Almost every single year, US stock returns clobbering international returns, whether it was political, geopolitical, currency, right? It just never got together overseas, and the US did get it together. I think that's changed. And so what we did, I talked about those ETF portfolios we had. We took our international exposure down to about 10% of those portfolios because there was just no performance that you were getting out of international. However, with the tariffs, and money coming out of the dollar and back into other foreign economies, we've started to see great performance in Europe, in other parts of the world. Obviously, exciting growth out of India and still with China. So we've increased our exposure to international, probably not as much as JP Morgan, Michael, but we're at about 20 to 25% of equity exposure in international in our portfolios now.
Wow, that's still a decent number though, considering. I mean, I think JPM is right up there too.
Okay, so we're in line.
But actually, I will take one last question. What is international to you? Is it Europe? Is it Asia? Is it India?
I think right now, Tracy, I would do I would do a mix of the EFA and the EEM, those ETFs. Maybe like 75% EFA, which is generally the industrialized. So that's your Europe and your Japan. And then your EEM is more the emerging, like the Latin America and India and China is how I would break that out.
John, we are out of time. And I want to thank you, as always, for being so gracious with your time and being a frequent guest and always providing our clients with great information. Thank you.
Well, thank you, Michael and Tracy. Appreciate the partnership and look forward to the next time I can come on the podcast.
In the meantime,
we need 2 hours next time.
I'm sorry, Tracy, go ahead.
We need 2 hours next time, I said.
John, I wish you and your family a happy holiday season.
Thank you. Same to you, Michael. You too,
And
Tracy.
Thank you. And Dom and I will be back next week with a new edition of the Lebenthal Report. Have a good night, everybody.
Bye-bye.